Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese. Each week, we dive into the important market-moving events and cut through the noise to help you, as an investor, identify what really matters. Let's get this show started. Hi, everybody. Welcome to the latest edition of Carson's Facts versus Feelings podcast with Ryan and Sonu. Sonu, we mentioned it when we started, and I forget what we said. What number are we up to? Do you know by chance? What number is this? What episode?
Lucky number 13.
All right.
I'm going to say lucky number. Lucky, you know.
Absolutely. It's going to be a very lucky 30 minutes for everybody here. We're going to have some fun. But Sonu, before we get into it, did you see the big news last week? I mean, the big news last week. A swimming dinosaur, one of those velociraptors that can swim, was discovered in Mongolia. Of course, it wasn't discovered. It's been dead for a long time, but apparently they found it. Are you a fan of those Jurassic World movies?
I love those. Especially, I still sort of get, dare I say, goosebumps when that music comes. You remember the first Jurassic Park, right? Literally.
Oh, yeah.
And it's a movie, right? It is a movie, obviously, but that first shot when those folks in the Jeep are looking at these dinosaurs and the music comes on, it's like, wow. I'm like, wow. And I love dinosaurs. Velociraptors are terrifying, by the way. And knowing they can swim too.
Well, I said that, the Lost World, they keep making bigger, faster, more destructive dinosaurs. And now they've got a whole new swimming one. And I remember, you mentioned that first Jurassic Park. I remember watching it on Sanibel Island, which obviously is...
really?
They're bouncing back. My parents owned a place on Sanibel. I remember watching it there, whatever summer that was, 92, 93, whenever it was. Anyway, so pretty cool stuff. So, Sonu, we've got a lot to talk about, as always. So we're just going to kind of dive in here. We're calling this one, Every Rose Has Its Thorn. Kind of a little play on some. We'll probably talk a little hairbands here in a minute or two. But what we're getting at, there's been some good news. Economic data just in the last couple of days has been really strong. Now the worry, the thorn is, could the Fed come in? Could the Fed be more aggressive? We'll talk about that. We're also going to dive in, I think, some really fascinating stuff. Sonu, you've done awesome work on it just lately. The U.S. dollar. The U.S. dollar is strong. It can have problems. It can impact earnings, kind of be a headwind. If the dollar is weak, like we think it can be next year, maybe it can be a tailwind. We're going to dive into that. Yeah. Then just some market talk. We've seen some pretty significant things happen just in the market, the way it's been reacting and acting that maybe suggests to us, again, some strength could be coming. So, again, every rose has its thorn. We'll talk hairbands in a little bit because I know it's what everybody wants to hear at this point. So let's start with the jobs number. That jobs number on Friday was really strong. And the market was sold off initially, but then it did come back to about flat. Then on Monday, we had more strong data. Some ISM services was strong, and we had some selling. Let's just kind of put all this together. Is good news bad news again?
So it almost started a month ago, right? We got that soft inflation report, the soft CPI, just backing up. And then we got industrial production, which is also kind of good. We got consumption and income data last week, and that's going up as well. And by the way, that's going up even after adjusting for prices. So it's not just nominal, right? It's real, as we call it, real as in adjusted for prices. Why is it going up? Well, the easy answer there is inflation's going down. So as gas prices go down, people have more money in their pockets and they're spending it, right? And payrolls, finally. Wow. Everyone is expecting about 200,000 jobs, which, by the way, is very good. I don't mean to minimize that. Powell had a speech last week. He talked about the fact that just to keep up with population growth, you need about 100,000 jobs a month, right? 200,000 is double that. Payrolls grew by 263,000 in November. Unemployment rate is at 3.7%. That's close to a 50-year low, right? I mean, it kind of doesn't get better than this, Ryan?
Well, maybe from that. Yeah, we're slowing down, but we're still growing, right? It kind of the thing we've talked about, the soft landing we think we can have. But let's talk for a second, though, about Powell here, because he did talk to the Brookings Institute, I believe it was, on Wednesday, and he apparently came off wildly more dovish than he has in a long time because the market had a huge day on that Wednesday and took it that way. I'm not so sure if he said that much different, honestly, but apparently the market took it that way. We're in the quiet period of the Fed, meaning there's no Fed members that can talk. And sure enough, the Wall Street Journal, is it Timiraos? How you pronounce his name?
Timiraos.
Yeah, he's writing articles. They're dropping it to him, and he writes their articles. That's how this works. Sometimes Janet Yellen gets out there in the press because they can't talk before the Fed meeting coming. But again, was Powell really that dovish last Wednesday, do you think?
It's all relative, right? And relative
Exactly.
to market expectations, right?
Yeah.
That's the world we live in, right? And day in, day out. It's not what happens on an absolute basis, though that matters. Like the economy is doing well. It's just a matter of uh, how much of a surprise these things are. Lately, the economic data is surprised. And then you had Powell last week. I think the surprise was that he was as explicit as he was, right?
Mhm.
It was in the air. It wasn't like, okay, they were going to raise rates by 0.75%, 75 basis points next week, right, at the December
Yeah.
meeting. I think markets are pricing in like, oh, it's just going to be 50 basis points, 0.5%. But Powell came out and said, like, they believe they need to continue doing interest rate hikes, right? But, and this is the most important but, right?
Mhm.
They're yet to see the full effect of everything they've done so far. They've raised rates by about 4%, right? 400 basis points. And they recognize they've done a lot already. And now they need to see the impact of that. So now they're talking about, okay, previously we wanted to manage the risk that we are not doing enough to fight inflation. Now we're trying to balance two risks, right? One is, okay, we don't do enough to fight inflation. The other side is we do too much, right? We over tighten.
Mhm.
That's now in the in the air. They're talking about that. That's a big deal, I think, especially with respect to what they were talking about a month ago or even 2 months ago. And I think
Yeah.
that's what was the big headline. They are going to slow the pace of rate hikes.
Absolutely. And I think I love how you put that, because what the Fed was saying a month ago, 2 months ago, 6 months ago, it is changing quickly. Now, the economic data is
Yes.
changing quickly. And we've said repeatedly some of the big potential positives we've been seeing on inflation, right? Used cars coming down a lot,
Yes.
rents coming down, housing prices, Case Shiller housing prices down 3 months in a row. Of course, I'm in my house right now. I want my house to be worth more. But these are some of those things that are saying inflation is also coming down, and that gives the Fed kind of a runway, if you will, to do this. Now let's take so jobs were strong. The worry though, Sonu, when you kind of peel back the onion, wage growth was up 0.6%, twice as much as expected. Again, let's be clear, the majority of the other inflation data we've seen over the past 3 to 4 weeks has been positive. That
Mhm.
wasn't, and that's what kind of upset the apple cart on Friday. Are you really worried that, oh boy, now wages are increasing more than we thought? Now the Fed is back to being more aggressive.
I'm going to put it this way. It doesn't matter what I think. It matters what the Fed thinks, right? So let's walk through how they think about this, I think.
Let's put on your Jerome Powell face mask and
Yes.
hat and think like the Fed chairperson right now.
Yes. By the way, yeah, wage growth was very positive, right? Zero, as you mentioned, 0.6%.
Mhm.
So just translating that, that's an annualized pace of 7%. That's huge,
Yeah.
right? Before the crisis, before the pandemic, wage growth was about 4 to 5% or so, right? And look, with the way the Fed sees it, they say, okay, if workers are earning more, they're going to spend more. And if they spend more, they're going to put more pressure on all the stuff we buy, and prices will go up. That means inflation will stay high. That's their basic framework. Now, I have some quibbles about this whole thing, the way,
Mhm.
the exact transmission mechanism from wages to price increases. Because look, like we're already seeing, we just saw 7% annualized uh, wage growth in November, but we know rental inflation's coming down,
Mhm.
right?
Yep.
We know that. I mean, the official numbers are not going to show that for another 8, 9 months. But the good news is the Fed also recognizes that, right? We know goods prices are coming down. Ryan, you've
Mhm.
written and talked a lot about this, about supply chains easing and all of that,
Yeah.
right? So all that is happening even as wage growth is really high, right? So I am in the camp personally that wait, I think there's a bit of a disconnect with what the Fed's talking about here, like wage growth, a strong wage growth translating into inflation. But that's fine. That's the way they work. That's what they believe. And that's the fear, right? If they think, yes, rental inflation's coming down, goods prices are coming down, but they, in a sense, the irony is they'll say 6 months or 8 months from now that that's just transitory. It's transitory deflation, not transitory inflation. Remember, we're talking about transitory inflation, but
Mhm.
maybe mid next year, mid 2023, the Fed will say the employment market, labor market is still strong, wage growth is strong. So we still not need to tighten, right? Because all the disinflation we're seeing is transitory,
Mhm.
right? That's the risk. I'm not saying that will happen. That is the risk. And that's what the market thinks the Fed is going to do as well. As long as they see the employment market really strong, that is the thorn amongst the roses.
Ooh, very, very
Going-
nicely done there. Brett Michaels, you pulled that out. Brett Michaels, very nicely
I don't know.
yeah.
I don't know if he was thinking about Jerome Powell and the economy, but
I'm going to say
Or-
he was not thinking about that. But probably thinking of something else, but that's all right. Anyway, so you think about it. I was going to say something that you got me all sidetracked with Brett Michaels here. Oh, now I know. The inflation. I mean, here, Master Yoda, I've used this quote before, but the great trader Master Yoda said, one data point a trend does not make, right? Most of the inflation data we've seen has been rolling over, coming down fairly significantly. You mentioned rents, right? Apartment lists, some great real-time data from apartment lists. They found rent prices were down 1% last month. Okay, 1%. Right. What's that mean? That's the largest monthly drop in their history, at least since 2017. The previous largest was the month before, when rents dropped 0.8%. So these are the things that you've talked a lot about that'll likely get to the government's work in 6 to 9 months or so. But again, Powell said, listen, we're aware our data is a little old. We know this real-time stuff is here. So good stuff. Now, we could talk all day on this. Let's talk about one more thing. I think it's interesting. Yesterday, all right, the ISM services number came in really strong. One of the biggest jumps we've seen. I forget the exact number, but it's well over 54, 55 or so, well over
56,
50%. Yeah, oh my, even higher than I thought. So bottom line, much stronger than expected. Like 15 minutes before that, the S&P Global had their PMI number, one of the largest drops we've seen in a long time. How in the world can one thing say one thing and another say another when they came out 15 minutes apart? Explain that to me, because I know it confused market participants. And then again, we had a big sell-off because every rose has its thorn. Services are strong. Services make up most of the economy. That scared people on Monday.
So let's maybe you should talk about what PMI is, right? Because that gets to what we are actually measuring here, right? Or when we look what they're actually, what S&P is measuring, what ISM, Institute for Supply Management. So what they're measuring, right? And they've been putting out. So PMI is basically a survey of purchasing managers across different industries, companies, all of that, right? So you have the manufacturing sector. People make apparel, machinery, electrical components, all sorts of things, and then the services industry, right, which is on the other side. And now ISM includes things like real estate and construction and services as well. But let's set that aside. It's manufacturing and services. Now, what they do is, let's say they call up 100 companies and 100 purchasing managers and say, okay, relative to last month, the previous month, are things looking good or bad or neutral, right? And let's say 75 of them say, okay, things are good. Okay, they check that box at 75. Let's say 20 of them say things are bad. And 5 of them say things are kind of neutral, right? So then the index is basically 75, number of people who said that's good, minus the number of people who said that it's bad, 75 minus 20. And then you get your PMI index at 55. That's basically, what's happening here. So one thing to keep in mind is it's relative to the previous month, right? They're not asking, is the trend downwards, or, looking back over the last 6 months, how does it look looking compared to last year? No, it's just relative to the last month, right? Keep that in mind. So S&P has basically a larger sample, right? S&P Global, I think, and they have probably more mid and small cap, the small companies. I shouldn't say.
I also saw they have more retail as well, so more mid cap, small cap retail, and a smaller sample size. So that could play with some of the numbers.
Whereas ISM is large, right? 300, and it's only their members. So you have like really large, 300 large companies, right? So ISM manufacturing, even beyond services, like last week, I think ISM manufacturing came out, and that PMI number was below 50. Anytime these numbers are below 50, that means that sector is contracting. That means manufacturing is contracting. Here's the irony, right? That index also showed that employment in the manufacturing sector was contracting. This is based on a survey. But then we got the payroll data, and manufacturing employment was up like 14,000 or something. Now, Ryan, who do you believe? Do you believe 300, purchasing managers, or do you believe actual data that's collected from thousands of manufacturing companies?
Which one comes from the government again? I'm going to not believe that one.
But so I think, there's a disconnect between the fact that one survey is asking large companies, the other survey is asking, mid and small companies. And we're just talking about inflation. Inflation's coming down for goods. One reason it's coming down is I think margins are coming down. And that,
Right.
we're talking about margins in the retail sector, whether it's gas stations, auto dealerships, footwear, apparel companies, things like that. Margins are compressing across the board. I don't think it's anything to worry about because margins are really high. So if it comes down a bit, that's great. And it helps our inflation problem. But I think that's what, these smaller and mid-sized companies are seeing. Like, oh, they're not happy about margin compression, right? And so they're saying, oh, things are worse than last month, right?
Great.
So I think that's the way I look at it.
Yeah, I mean, great discussion there. Just interesting. Those two data pieces came out within 15 minutes of each other and gave fairly different opinions of things. But the bottom line, again, is a good deal of the economic data we've seen over the past, we'll call it week, honestly, the past week. Factory orders, right? Factory orders yesterday came in at 1% month over month, expected about 0.7. Again,
also above expectations.
Than expected. Exactly, all about those expectations. So again, those things kind of led to the approximate 2% sell-off we saw on Monday, although stocks did finish off of the lows. So good discussion there on every rose has its thorn. Have you how are you guys doing with the flu? My wife had the flu last week. I know you actually talked about the flu potentially impacting some things. I'll tell you, it wiped her out for 4 or 5 days. She had her flu shot. I guess it didn't matter. Fortunately, I got mine. I didn't get it. You guys avoiding it in the household?
Goodness no. My daughter, I have 6-year-old twins. My daughter is out with the RSV virus. I mean, it's amazing after I've had kids, how many things, new diseases, viruses, set aside COVID, right? I think that was new for all of us. But like strep throat and there's all sorts of things. But no, she was down for a week. She missed school and Thanksgiving recovered, went back to school, and now she's back home again, by the way. So
she's sick
she's
again.
Ill again. She's sick again. And
is that like a double dip recession? Oh my goodness!
I know it's a double dip wire.
Yeah, now the twin, the other one didn't get it though. I guess
it's like a control experiment, right? We have two exactly the same. They go to the same school. They're living in the same household, different rooms, but girl and boy. So maybe there's a difference there, and the way their constitution is.
That's it. Well, there's something. That's interesting.
He's fine. I don't want to jinx anything. He's fine so far.
Exactly. We'll stop talking about it. Yeah, but I mean, we've seen the numbers. There is little doubt that this is one of the worst flu seasons we have seen in a very, very long time. And again, people that are getting it, it's not just wiping you out for a day or two. Like I said, my wife was out for 4 or 5 days, and she even had a flu shot. So it's it's tough. It's tough. So if anybody gets it out, definitely stay healthy.
That may be affecting some of the employment numbers as well. Like we've talked about in the past, there's 2 surveys, right? There's a payroll survey, payroll data, which comes from the BLS, Bureau of Labor Statistics, talking to establishments, right? That's a much larger survey, about 130,000 businesses, something like that. And then you have the household survey. You have, they call up households, about the smaller one, much more noisy. That showed that employment actually went the other way. It was negative, right? And there's all sorts of methodology differences, things like that. But part of it is the labor force actually shrank in November. And I think a big reason is the flu season is, like you said, the worst in 13 years. So people are missing work based on that. So I think there's a lot going on there. And I don't think we're quite out of COVID. I mean, I don't think, we're not in that situation like back in 2020 or 2021 with Delta and Omicron and all that. But I do think it's going up, which means hospitals are not getting full, thankfully, but people still may have to miss a day or two of work.
Yeah, no doubt about it. I mean, you mentioned the household survey down 138,000 last month, down 328,000 the month before, and we were seeing solid jobs gains according to the government data on the other side. So again, this is some interesting dichotomy that we are seeing. But again, hey, every rose has its thorn, as we said. So let's we've talked a lot about this. We want to try and wrap this up in about 10 minutes or so, Sonu. So let's take a minute and talk about the U.S. dollar. U.S. dollar was up nearly 20%. All this time, maybe a month and a half or so ago, then down 5% in November, one of the largest monthly drops we've ever seen in the dollar. You've done some amazing work previous times that we've had strength in the dollar. It has impacted earnings fairly significantly. So I think it's safe to say probably that it maybe impacted earnings this year, but could it be a tailwind next year if that dollar can just stop going up or maybe even start to go down?
And that would be the third time over the last decade, this has happened, right? 2012, the dollar, I mean, just from memory, I think it went up about 10%. And we had a so-called brief earnings recession, right? Earnings year over year went negative, about negative 1%. And then 2015, 2016, you remember when then oil prices crashed and the energy sector is getting it. The dollar went up a lot, 15%, something like that.
According to your notes, Sonu, real fast, you said dollars up 23%. This is your notes. I think 23%, and we also had a manufacturing recession back then. Remember, manufacturing was definitely in a recession, and earnings were in a recession. But we avoided a big
PMI.
recession.
Yeah, we were talking about the manufacturing PMI, right? By the way, folks, for the U.S., it's services that matter, right? At the end of the day, it's not manufacturing. Manufacturing is about 12% of the economy, and about 14% of jobs, something like that, right? It's all less than 15%, which is not to say it doesn't matter. It matters, right? And it matters especially for earnings. But I think where that connection comes in is through the dollar, as you mentioned, right? PMI has been down, but we are talking about, again, when you're talking about manufacturing PMI, you're talking about 300 largest companies, and they're multinationals, right? And when you think about the S&P 500, 40% of S&P 500 revenues come from outside the U.S. So currency has a big impact, right? So 2013, we saw earnings go down or be soft when the dollar was up. We saw the same thing 2015, 2016. We're seeing the same thing this year, and earnings are about up. Last quarter is up about 3% year over year, something like thereabout, which is softer. I mean, of course, we're coming off of like 20-30% gains, which is the recovery after COVID, right? But still, it's soft, right? And I think one big reason is, yes, the dollar is strong. But to your point, look, the big reason the dollar is strong is the Fed's increasing interest rates by a lot more than other countries are increasing their interest rates, right? And you think about a country like Japan, they're not even increasing it. Right. They're keeping it close to zero. So suddenly you think there's a 400 basis point, 4% differential between Japanese government bond yields and U.S. government bond yields. Goodness, well, you want to put your money into the dollar because you earn more, right? So I think that's one big reason the dollar's gone up. But that's it, right? If the Fed doesn't raise much interest rates by much more, I think we'll probably close to a peak, dare I say, for the U.S. dollar. Worst case, it will stop going up, as opposed to whether it comes down or not is another thing, but it'll stop becoming a headwind, I think.
Absolutely. I think we've said it before. One of the bigger surprises this year has been how strong the U.S. consumer has been. We talked about the consumer a week ago, so go check that podcast out. But the other one is how strong the dollar was, having one of the best years ever. Now, it's come back, since November or so. But just look in history. Let's keep it real simple. When you have a lot of dollar strength, usually risk assets don't do very well. I'm looking at you 15, 16 during COVID, and sometime in 2012. Now, 13, you mentioned earnings didn't do much in 13. S&P gained almost 30%. So let's just kind of remember that one. But the key concept being, again, if the dollar starts to weaken like we think it likely could into next year, that can be a tailwind. Earnings this year, this is FactSet estimates, maybe about 5% year-over-year earnings growth this year. Okay, on this very podcast 2 months ago, we said we maybe could hit double digits. Not looking like it's going to happen. A lot of that is because that dollar's been so strong. It's hurt some multinational companies, but maybe it can be a tailwind next year. There can be 3 to 5% more upside to earnings next year that people aren't really pricing in because they aren't expecting the dollar to come down significantly. And I'll tell you, we think that could be potentially what could happen. So we've got a few minutes left. Let's talk about what everybody wants to hear. What is your favorite hairband? Since this is titled Every Rose has its thorn. What is your favorite? We were talking. You guys should have seen it. You guys should have we should have recorded earlier. We were getting into it a little bit. Sonu was actually singing "Every Rose Has Its Thorn." You wouldn't believe it.
Oh goodness! I think I could play it on the guitar at some point, but I won't
really
play that anymore.
Oh my goodness!
No, way a long time back.
Do that?
No, no, we shouldn't. But maybe something else. I think I was always more into the 70s. Bands. Does Queen count when they had the long hair and stuff like that? No, it's not a hair band. They're 70s,
no,
right?
But I don't know.
I'll pick Def Leppard, I think.
Yeah,
I'll pick that.
If
you put me on the spot, what about you? You're an 80s kid as well, right?
Yeah, I like the Crew. I'm a Motley Crue. So over the summer, I saw the stadium tour with the Crew and down in Charlotte, the Crew and Def Leppard and Poison. Now I got there a little late, did miss Poison, but those two are great, and I do enjoy some of those. But I always like Motley Crue. So seen them once or twice. And Def Leppard was pretty awesome also. So it makes you excited because, I mean, it is cold. It's getting colder. It's holidays, which is great. Don't get me wrong. But now maybe some of these summer tours are starting to kind of leak out. We already talked a ton about the Taylor Swift. My God, I don't see how you're going to have a recession when people are spending the money they're spending for Taylor Swift and all that stuff. But we can talk about that at a different time. But it's just kind of fun to think, okay, good. 6-7 months, I'll get to go outside and listen to some good music. So that'll be very exciting. Sonu, the final thing we wanted to talk about is just kind of the stock market, right? The reaction of what's going on. We've had some really cool things happen, guys, some noteworthy things. And I'm going to take a minute or two and talk about some of them here. We just had back-to-back 5% gains on the S&P, 8% gain October, about over 5 or so in November. What does that mean, right? We've talked before about the idea. Everyone says this is a bear market rally. Well, when you look back in history, we saw 13 times that's happened since World War II, back-to-back 5% monthly gains. A year later, higher every single time. 13. There's that lucky 13, by the way. 13 out of 13, up 22% on average. Again, just one data point, yes, but I think this is more than just a bear market rally. This is some substantial buying, which is not what you see in a bear market rally. It's actually what you see closer to the end of a bear market. Two more. We just went over 7 months, almost 8. Beneath the 200-day moving average. A little geeky. That's just the average close the previous 200 days. I get it. It's totally random probably, but CNBC and everybody talks about it. We closed above it on Wednesday when we got that little bit more of a dovish Fed. So the first time in over 7 months. I looked. When you have at least 6 months beneath the 200-day and you close above it, 13 times this happened. A year later, higher, 12 of them, up 19% on average a year later. The final thing I wanted to talk about here, this is a midterm year, right? We know that. When you have a negative midterm year, that following year, that's a pre-election year, has been higher 8 out of 8 times, up 25% on average. We've talked before about midterm years not being that great. Pre-election years next year usually are strong. Pre-election years are actually significantly better when you're down that year before, like we're likely going to be right now. So, Sonu, I just dropped three things. Like I said, any one by itself, maybe not. But when you start combining these, start layering on top of each other, to me, it is saying October was the lows and be open to upside surprise, especially if that dollar can start to weaken like we think it can. Next year could be pretty good, I think. We're not going to give away our outlook yet, but Cliff Note version is I think it could be pretty good next year, right?
Yeah, and can I ask about the 200-day moving average? I mean, we've talked about midterms before, but I'm not, dare I say, technical person, but I follow the 200-day moving average. So it's just the easiest thing to do, right? Seems probably why everybody's talking about that one. So could you talk a little bit more of why that's important and how that relates to how volatile markets are above when stocks are above or below that 200-day moving average?
Great point. I mean, there's an old saying, right? Nothing good happens beneath the 200-day moving average. When you start to see some of those volatile days ever, I took a look at this in the previously, not recently, but we'll call it maybe 3 to 6 months ago. I looked at the best 15 days ever for the S&P 500. These are the best 15 days. You're talking big gains. 14 of them took place beneath the 200-day moving average. Not surprisingly, like 19 to 20 worst days ever took place beneath the 200-day moving average. What I'm getting at, there's more volatility there. 2008 is a perfect example. We saw a huge amount of big gains on certain days in 2008. You're talking 2, 3, 4% gains in 2008. Wait a minute, stocks are down 38% for the year. They were, because there are even bigger down days. That was because a big chunk of that year was beneath the 200 days. So to us, it's a nice long-term trend line. Once you get above it, things are a little more calm, a little more normal. I will say, though, on Monday, we did pop back beneath it by a tad. So we're flirting with it, but just the fact we got above it. One of the big difference, maybe the last point on this, people say this is just like the summer rally, right? We've rallied like 15%, give or take. Had a 17% rally in the summer on the S&P. Went up to the 200-day and rolled over. We popped above it this time. Also, we're seeing a lot more participation. How many stocks are above their 200-day moving average? How many sectors are above their 200-day moving average? There's a lot more sector participation and stock participation now than in the summer when we had that bear market rally when we rolled over. Nobody knows exactly. When you start putting all these pieces together, I think it does suggest, hey, first 2 weeks of December can be little weak. Honestly, Santa Claus usually comes to town later in the month. We'll talk more about that soon enough. Just be aware that seasonally, we had the up November. November is a great month. We talked about that a ton last month, and sure enough, it happened right and off the heels of October. So, you put it all together, it's more positive than not, in my opinion. So, Sonu, last thing, we need to probably wrap it up. Looks like this is a pretty calm week because it's all about the Fed. There's like no data really, no major data. What are you watching for this week, or maybe it's just a chance to catch our breath?
I think catching a breath, and which is why I've been thinking about the dollar. We just talked about it, right? And like sort of big picture, what could be in store for next year, right? And in short, it looks like a lot of things that were headwinds this year. Maybe the 200-day moving average too, being below that for most of the year, that was a headwind. It's more volatile, and if you're above that going into 2023, or if we like break above that and stay above that for a good period of a few weeks and things, that's a good sign. And all these things that were headwinds in 2022, maybe they become tailwinds in
Yeah,
2023.
I think so. Absolutely. And, the terrible war, maybe we can finally get some good news on that front as well,
Yes.
that we didn't see coming this time a year ago. And obviously it's impacted so many different things as well. So guys, we're going to wrap it up this week. Every rose has its thorn. I will say congrats to my Bengals. I was at the game on Sunday. We beat the Chiefs for the third time in one calendar year. You don't see that every day, beating a good team like that 3 times in a row. So yeah, Joe Burrow owns the Chiefs. He just can't beat the Cleveland Browns. He's 0-4 against them. We don't need to get too much more into this. Hopefully they can fix that.
Some good news for the state of Ohio.
Yeah, that's finally we can use it. We need it. So anyway, but guys, thank you as always for being here this week at Carson's Facts versus Feelings podcast with Ryan and Sonu. You keep listening. We're going to keep doing it. We're inching into the holiday season. Hopefully things calm down a little bit, but we're still optimistic this rally can have a little bit more in the tank and have a little Santa Claus come to town. But we'll get into that soon enough. But hopefully you enjoyed it. We'll see everybody really soon. Take care. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Dietrich are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.